Hello, everyone. I'm Miles. I'm glad to have another opportunity to discuss with you some basic accounting concepts in investment banking and modern finance. As we all know, there are some very fundamental and crucial accounting concepts in finance. For example, the three financial statements. The first statement is the balance sheet, also known as the statement of financial position. The balance sheet is just a snapshot, meaning it only shows the assets and liabilities at a specific point in time. Because a lot of times you also have short-term investments. For example, Buffett's company has a lot of stock investments and a lot of what else. These investments, their value actually changes every second, so the balance sheet is just a snapshot at a fixed point in time. It includes your assets, liabilities, and equity. Based on this, the balance sheet is extremely important because it contains a lot of crucial information that measures the health of a company. For example, let's look at practice questions to understand current and non-current assets. Current assets are short-term and non-current assets are long-term. The dividing line is 1 year. Assets convertible to cash within 1 year are short-term. If it takes over a year to convert them to cash, they are long-term assets. Similarly, short-term and long-term liabilities are also generally separated by the 1-year mark. Alright, let's look at the basics. Short-term assets mainly include cash, accounts receivable, inventory, prepaid expenses, those already paid in advance, as well as short-term investments, and so on. So what about short-term liabilities? Accounts payable, right? Current payables, and also accrued expenses, that is, expenses that have already accumulated but haven't been paid yet, as well as deferred revenue. We'll have a chance to discuss these later, like so-called unearned revenue, which is revenue that hasn't been received or earned yet. Alright, interest payable and current maturity of long-term debt. Now, today let's first take a look at short-term assets and short-term liabilities, because these are very important metrics for investment banks. They're crucial indicators for measuring liquidity. Alright, so let's look at a few problems to understand. First, what is working capital, also known as work capital? The so-called working capital, in its most classic definition, is simply current assets minus current liabilities. In this problem, it's 930 minus 850, which is exactly 80. We can see our current assets. Total current assets are 930, and our total current liabilities are 850, so that's 80. It's simple. Of course, in investment banking, modern finance, or corporate finance, working capital has different definitions: net working capital, operating working capital. So the specifics depend on the situation. But the standard definition is current assets minus current liabilities. Now, in this context, let's look at two important ratios anyone in finance must pay attention to. One is the current ratio. From this definition, what can we usually tell about the current ratio? Current assets divided by current liabilities, 930 divided by 850, which is about 1.09. Obviously, greater than 1 is good, and less than 1 is definitely not so good. Short-term assets must be higher than short-term what? That is, liabilities. They need to be higher, and the higher the better. Okay, so in this situation, we can look at an even more important indicator called the quick ratio. When you see this, sometimes it's also called the asset ratio. No matter what it's called, it's basically the same thing, just a different name for the same concept. That is, how quickly your short-term capital assets can be converted into cash to pay off these short-term liabilities. In other words, here we need to remove all the assets that aren't very liquid. So among short-term assets, which ones are the most liquid? Of course, cash, and also accounts receivable. Accounts receivable are usually accounts that must be collected within 30 to 90 days. And then there's also short-term investments. These three are the most liquid, okay? Especially when you add inventory. What is that? It's very illiquid because inventory often includes a lot of raw materials that can be bulky and hard to convert into cash in the short term. So that's why it's cash plus accounts receivable plus what? Plus short-term investments. These three categories are the most liquid, the easiest short-term assets to turn into cash, plus current liabilities. In this problem, it's actually very simple. 250 plus 180 plus short-term investments of 110 divided by what? Divided by total current liabilities of 850. Alright, you can do a quick calculation and see that 250 plus 180 plus 110 divided by 850 gives you an answer of about 63%. Obviously, the quick ratio is an indicator that's even more about survival. Of course, it's best if it's greater than 1, the higher, the better. That means your cash reserves are very strong. Even if it's not cash, let's say short-term investments, like what things like short-term treasury bills, short-term bonds, and so on. The more of these assets you have, the better. Of course, in this situation, if everything is turned into cash and you have no fixed assets at all, that's obviously not right either. A company still needs to operate, but from the perspective of, still, the higher the quick ratio, the better. Alright, so to sum up, all these indicators are telling us whether a company truly has good liquidity. Okay, or is it what we call having a lot of profits, but they're just trapped on paper? For example, if we have a lot of inventory, a lot of PPE, and heavy investments in factories, with warehouses packed full, it might look like we have a lot of assets. But if there's actually a liquidity crisis, and our accounts payable are also very high, along with a lot of long-term or current liabilities, then our quick ratio might be only 0.1. In this situation, these companies would be in bad shape. This is a core measurement.